Good morning, everyone, and happy Monday to everybody. My name is Tony Butler. I'm one of the life sales directors here with Insurance Agency Marketing Services, and I have with me Brent DeGroot with One America. He's regional sales director, brokerage department there at One America. We're going to be talking with Brent in regards to some things with One America. But before we get started, wanted to point out just a few things here that we offer here at Insurance Agency Marketing Services. So be real brief with this. First and foremost, we always have conversations with our advisors in regards to how they can earn additional money. So we've got several perks for advisors to do just that. One is our new producers builders, and depending on the business that you do bring in, there are additional perks, if you will. You see 5 different levels here, so you can go from anywhere from a Ritz-Carlton package to some mailers to additional sales materials to help you grow your business. If you have any questions or want more information in regards to our new producers builders, please feel free to reach out to any one of the sales directors. We'd be more than happy to go into greater detail on this. We also have our IAMS Business Builders, which is a referral program that we have for advisors. So any agents that you're friends with or have a business relationship with that they're looking for a new FMO, definitely send them over our way. If they do get appointed with any of the carriers that we work with, we do provide you with a $50 referral bonus, and then any subsequent business that they write, depending on the business that they write, there's additional monies there for you as well. Again, if you have any questions, please feel free to give us a call. Be more than happy to go into greater detail on that with you. We also offer you back office support. We want you to work harder, not smarter, so or smarter, not harder. Potato, potato. Anyway, that all entails from just working from submission to commission. So we do have business building tools for you. Our website can provide you with the ability to do both life and annuity quotes. We do offer paperless contracting, so definitely can help you streamline your business. Our website is a 24/7 website. We've got excellent sales tools on the website. If you're a life insurance producer, you can do both term and universal life quotes on our website. You can access forms online. We do have our annuity and long-term care product grids available to you. As you see there, our website is www.imsinc.com. In this environment now, a lot of advisors now are strictly doing paperless applications or e-applications, if you will. We have a couple of platforms available for you for e-applications, one of which is Firelight. Now, Firelight is available if you get registered through our website. And as you see here, the majority of the annuity carriers that we work with is on the Firelight platform. We have a few life carriers on the Firelight platform. We also have iGo eApp solution, which can also be accessed on our website. The majority of our life carriers are on that platform. If you need assistance as far as getting registered to either our website or Firelight, please reach out to us. Be more than happy to walk you through that. We also offer you creative marketing solutions, whether it's turnkey, agency, or digital solutions. What that means is if you need assistance with your business as far as personal website, email marketing, logo designs, business cards, newsletters, professionally written handouts, we can provide assistance for you on that. We also offer to our advisors the Retirement Analyzer. It is free for qualifying agents. We do have a tutorial if this interests you. The Retirement Analyzer can help you answer questions from your clients as far as how would it affect my family if I enter a nursing facility? When can I retire safely without running out of money? If you need more information in regards to our Retirement Analyzer, definitely give us a call. Be more than happy to run you through those materials. And for your higher net worth clients, we have our IAMS Wealth Management team. They've been there for, I want to say 3, maybe 4 years now, if not longer. Charles Jr. and his team have done an excellent job in helping advisors increase the agent's revenue, improve client retention, and strengthen those relationships. Definitely reach out to them on that. Be more than happy to help you out there. Life and Annuity Academy. We just did our last one here about a month ago, I believe. It is a 2-day training that we do pay for. If you're familiar with IAMS, you know we try to do these a couple of times a year. I know that we're planning on possibly doing one here in the spring. As far as the 2-day training, it includes not only information from top producers, but we also provide you with sales ideas and strategies to help grow your business, large life case marketing information. I think I may have a polling question on the Academy. I'm going to double check and see. If I don't, you can definitely reach out to us and we'll be able to provide more information on that. Let's see. Nope, I don't. But if you have any questions regarding the Academy, definitely give us a call. And lastly, we do have a trip, the mountain retreat, our themed mountain retreat in Hotel Park City. It's $3 million in a themed annuity premium to qualify. As you see here, the qualification periods are from January 1st of this year all the way to December 31st of this year. We do have several agents that have already qualified. If you have questions on where you're at as far as qualifying, definitely reach out to us. Be more than happy to give you more information on that. So with that, Brent, you there?
I sure am.
All right, Brent, I am going to change the presenter over to you.
Wonderful. While you're doing that, I just wanted to mention, every time I present with the folks here at IAMS, I'm just blown away by all of the extras that you guys offer. So what a great organization. And I'll tell you, last year I stayed at that property in Park City. Absolutely beautiful. So any of those that you're are going to be joining them on that, whoops, I got the wrong screen up here. You will be more than pleasantly surprised. It is a great, great property. All right, let's do this. Let me make this big. I'm probably going to have to quickly switch this. There we go. All right, Tony, can you confirm that we're now full screen and just seeing kind of a slide of downtown Indianapolis?
Yes, we are full screen.
All right, excellent. Well, that is great. Well, hey, I want to thank everybody for coming out today. Tony, I want to thank you for lining this up, and everybody at IAMS for giving me a moment to just kind of present some information, and very timely. First and foremost, before I get started here, I did want to mention we just wrapped up Long-Term Care Awareness Month in November, so we're in December, so obviously we're outside of that, but what's really interesting for all of those on the call today, one of the two biggest times that we start to see claims actually start is right after Thanksgiving holiday, largely because, families are gathering around the table and they may see some changes in mom or dad or a loved one and really start to take an interest in that and maybe even start to claim. So the other time is right around Easter. And again, it's the same sort of thing. So thought I would quickly mention that. We typically see a large amount of claims that just recently started. So very timely to be talking about this. The second piece that I wanted to quickly mention, we on Friday just announced a rate some enhancements to our asset care product line, rate reductions. This is the second time this year that we are doing some rate reductions. So that is a great thing for any of your clients out there that you're working with to plan for long-term care and the risks that are associated there. So we had our second round of rate reductions, largely because the interest rate environment is on the rise. And as a mutual company, we are always thinking in terms of our customers, which are your clients. So want to invest and give them the lowest premiums possible. And since we're getting better returns, we can then lower premiums. Along that same line, one of the other enhancements that we made too is increased a bonus on our annuity funded whole life. And if you're not familiar with what that is, really it's using qualified funds for the most part. And we can always follow up and do some more presentations around that. I know I've talked on that in the past couple of years, but if you didn't happen to see that, certainly reach out to your marketer there at IAMS and they can walk through that with you. All right. I will mention one other thing before we get into the presentation, because it all kind of has to do with taxes. And this is really a review of LTC and the tax benefits that could be there, or tax deductibility. And one major piece that I will mention, and it really stemmed from some things that happened last year, the state of Washington implemented a tax to any of their constituents who did not have a long-term care plan in place. They're still working through that. There was an absolute nightmare for all of us in the long-term care insurance planning space. As a matter of fact, it just overloaded the system the way Washington did it. But what people were trying to do was save themselves from an ongoing tax for the rest of their working years. And I will say this, while Washington State is now still making some changes around this, there are a number of states that are also looking at this. So for those of you on the call, and if you happen to be in Oregon, California, Alaska, Hawaii, Utah, Colorado, Missouri, Illinois, Minnesota, Michigan, North Carolina, Pennsylvania, or New York. We don't have plans in New York, but if you're in New York, just know that those states are looking to maybe implement exactly what Washington State did. And the best advice that I could give you is work with your clients now. Largely what those other states that are looking at this will not do is allow a going forward date to have those plans in place by. If they put that legislation in place, it'll probably say, as of this date that the legislation takes effect. If they don't have their long-term care plans in place, they're now going to have an ongoing tax for as long as they are in their working years. So just a fair warning for you out there in those particular states. Okay. So let's get into what we're talking about today, and it's really a review of long-term care and the taxation or benefits that can be there. And of course, I need to start with a little disclaimer here, because I am not a tax attorney, I'm not a CPA, any of those. So this material has been prepared for informational purposes only. And once or you see this and you want to use this, make sure your clients are working with any of their legal teams or accounting advisors before engaging in any transaction. I have to put that disclaimer out there, but I've been working in this long-term care field now for over 20 years, so I'm very well versed in the pieces that are out there. But again, I am not a CPA, a tax attorney, and we'll have to put this disclaimer out there. Okay, that being said, let's get into a couple of things that really help us when we're talking about tax deductibility, or ways that may encourage your clients to purchase long-term care protection on themselves. And a number of things that we're going to be quickly talking through: HIPPA, Health Insurance and Portability Accountability Act, the PPA, Pension Protection Act, and HSAs, Health Savings Accounts, are three items here that you need to be aware of. So we'll start with HIPPA. And first and foremost, when HIPPA was established back in 1997, it set some standards for long-term care insurance plans. So it did a lot of other things as well, but it set some standards for long-term care insurance plans. And it said if they met some federally qualified rules, the plans would be considered not subject to federal income taxation. So as long as they were tax qualified, they would not be subject to federal taxation. Qualified contracts, those tax qualified contracts, must have several benefits and consumer protection requirements in play. So what also HIPPA did is created Internal Revenue Code section 7702B, and it basically said that if it was going to be a tax qualified plan, there must be a plan of care described by a licensed healthcare practitioner. And in order to receive benefits out of this tax qualified plan, that licensed practitioner must certify that that individual is chronically ill, not acutely, but chronically ill, and must be unable to perform at least 2 of 6 daily living activities, or ADLs, activities of daily living, or require substantial supervision due to their severe cognitive impairment. And when I say chronically ill, that means care needing or lasting 90 days or longer. So acute care, where maybe health insurance would come in, are for those acute situations that are not chronic in nature. They are there to be solved, or helping somebody get better quicker. But chronic is considered 90 days or longer. So if I move forward here to the Pension Protection Act, another piece that really helps with taxation around long-term care, what the Pension Protection Act did, really, again, large reforms in pension governance, but Section 844 of the Act dealt specifically with annuities and long-term care and tax advantages for that. So basically, as of January 1st, 2010, so now 12 years ago, almost 13, we've had this PPA in place, and these special rules around long-term care planning with non-qualified annuities, so specific annuity contracts, and for that I'm going to label them non-qualified. So if a individual wants to use a non-qualified annuity and pay for long-term care expenses or long-term care premiums, they can. And they are no longer considered taxable as a reduction of their cost basis. So benefit programs from long-term care insurance riders are also not taxable. So what I'm saying here is, if your clients happen to have non-qualified annuities that they have had in their portfolio for any amount of time, all of those non-qualified annuities have substantial gain in those contracts. The longer they've had them, the more gain in that contract. If they leave those where they're at and use those for any long-term care services, because 9 times out of 10, those non-qualified annuities are not going to be HIPAA compliant or PPA eligible, it would say that the interest, the gain in those contracts, is going to be taxable to them when they take those distributions. What the PPA really allowed us to do is to 1035 exchange, a simple application to 1035 exchange that existing non-qualified annuity and move it over to a HIPAA compliant, PPA eligible non-qualified annuity. And now all of that gain, the whole annuity, really becomes tax-free if used for long-term care insurance purposes, whether it's paying insurance, paying for the insurance, or for any benefit dollars. If they did not use that for long-term care purposes, it's going to be taxed just as it was if it was used there. So a great planning vessel here came out of the Pension Protection Act in just using existing non-qualified annuities with a large tax burden for them, lots of embedded gain. Now we can get rid of all that embedded gain. Well, not really get rid of it, but we can make it tax-free if used for long-term care purposes. All right, enough on the PPA. The next thing I wanted to talk about was the health savings account, otherwise known or originally known as MSAs, medical savings account. They are now grandfathered to HSAs. But basically, out of an HSA account, people can use the pre-tax money to pay for LTC premiums or LTC services using that tax advantage status. So HSAs have been around now for a number of years as well. Many people having these HSA plans have established a pretty good, healthy amount of savings in those vessels, and now they can use those either for premiums or for care needed as well. So those were the big three that I wanted to talk about as far as really helping us plan as advisors with our clients for planning for long-term care purposes. So now let's get into the premium deductibility portion. And again, knowing that all of the plans that we have here at One America are considered tax qualified by IRS standards or by HIPPA standards, they would be considered deductible, depending on how that individual files. So this premium deductibility that I'm going to be talking about now, I label it myself as a good, better, or best situation. And it all depends on what type of taxpayer they are. Are they just an individual, or are they an employer or an employee? And we're going to walk through each of those levels. And again, I say a good, better, or best scenario, and we'll walk through all of those. So again, depends on what type of taxpayer they are. Now, the benefit of taxability here, benefits paid from a qualified LTC plan, like we have here at One America, are all considered tax-free. So any benefits that your clients are receiving will be tax-free by nature because they are a tax-qualified status by HIPAA and the IRS standards. Indemnity or cash benefit policies will also be considered tax-free as long as they stay up to or below the per diem amount. And in 2022, that per diem amount was $390 per day. So if they have an indemnified policy and they get above $390 per day, that portion now can be taxable to that recipient. So I wanted to know that there. So let's talk about indemnity and reimbursement policies. We are a reimbursement policy here at One America. And I think that there's maybe some misnomers around this. I'm going to go a little off the slides here, but I just wanted to kind of quickly point out the differences between indemnity and reimbursement. When people naturally hear reimbursement, they think, okay, I've got to save receipts. I've got to make sure that I submit them to the insurance carrier now to be reimbursed for any services that were paid for. That would be on a very high level, that would be exactly what would typically happen. However, here at One America, what we do is we coordinate with the care provider that your client would be choosing. And what happens is the care provider then bills us directly here at One America directly. We pay them directly, and we just provide an explanation of benefits to the client. So there is no saving of receipts. There is no submitting them to get reimbursed for this. It all happens behind the scenes, and it's very simple. Once we set up that plan of care, we establish who those providers are. They bill us directly. We pay them directly. On an indemnified basis, some of our competitors have indemnity policies. Again, at a high level, very simply known, that's where you're going to get all the money up front. You qualify for benefits, you get the money up front. That seems like it is an easier process. However, there is a person, I shouldn't say a person, there is a government entity that very much is interested in who is getting that cash, and they are the IRS. So while those benefits get paid directly to, again, it's not going to be the person who's needing that care because they're already incapacitated. largely a family member. But what happens is the IRS wants to know, how did you receive those benefits, and start tracking those benefits. So now you've got to save receipts. You've got to provide those to the IRS. They're going to follow the money trail and figure out if somebody needs to be taxed here. So again, on a high level, it seems like indemnified would be the best or easiest way to go for any client, but it's just the opposite. That may cause them to be saving receipts. Well, it will, because the IRS wants to know. On a qualified basis, on a reimbursed basis, you cannot go over the per diem amount, so you're not going to be taxed on that. And we coordinate with those providers, so it's a very simple process. So I thought I would mention that since we're talking about indemnity and reimbursement policies here. All right, back into the deductions, and depending on how they file or what type of consumer they are, what deductions are available to them. Now, I keep saying good, better, best. The good situation is just an individual in and of themselves. However, I say this is a good situation because it can apply to certain individuals, but it may not apply to most. And here's why I say that. To be able to receive a portion of the premiums that they paid as a tax deduction as an individual tax filer, they need to do a couple things. They need to jump through a couple hoops for the IRS. First and foremost, they need to show that they've got expenses, unreimbursed medical expenses, over and above a 7.5% adjusted gross income. So that's first and foremost. They must also save those receipts and file an itemized tax return. So they've got to, show those itemizations of those non-reimbursed medical expenses that are over and above that 7.5% adjusted gross income. So those are really the two hoops that they must jump through as well. And then they'll go to an age-based premium table, which I'll talk to you here on the next slide. Why we don't see many individuals taking this deduction is because the standard deduction now for taxation has risen so high. On a single level, we're $12,950 for 2022. On a joint basis, $25,900. So because that standard deduction has increased to such a high amount, most individuals or joint are just saying, I'll just take the standard deduction. I don't want to itemize all my plans. I don't want to show any expenses over and above a 7.5% adjusted gross income. And so they don't take that. They just take that standard deduction. Still a good situation because they could. Now let's look at this age-based tables. So like I said, you saw the first two hoops that an individual would have to jump to. Then we come to the IRS's table for the premium amounts that they could deduct. So you can see here they're in 10-year age bands, and certainly up to age 60, for those adjusted gross incomes, they may not be that much of a deduction available to them. Once they show that 7.5% adjusted gross income after doing all the itemization and they come to this age-based table, if they're under age 60, yes, there's some form that they could possibly take a tax deduction for them, but those amounts are much lower. However, if you start to look at the 60 to 70, so really more than 60 to 70, so 61 to 70 or more than 70, you start to see some substantial amounts as far as what can be taken. So they still must jump through those hoops, show the over 7.5% adjusted gross income and itemize, but now they come to this age-based table and they find where they fall on those 10-year age bands. And that's the portion of those pieces that then they could deduct. So it's still a good situation. Really, largely, I think it has to depend on, well, a couple things. One, how many unreimbursed medical expenses do they have? Do they have enough to even get over that 7.5% adjusted gross income? And two, what are their ages? Because now we start to see substantial amounts or more substantial amounts at 61 and above. So the three hoops that they've got there for an individual, They must itemize, they must show unreimbursed medical expenses over and above the 7.5% adjusted gross income, and then they come to the age-based tables here and find that portion, how much they can take a deduction. That's on the individual basis. So there are one things that I do want to quickly talk about still with individuals as well. So eligible premiums can be paid from their MSA or HSA as they are known now, or HRAs. So they still have that ability, and I talked about the HSAs early on in this presentation. What is not available for any tax deductions here is if they are taking eligible premiums from an an FSA or cafeteria plans. So employees cannot use any pre-tax funds to pay for long-term care insurance. So just wanted to quickly point that out, but the HSA portion is still available to those individuals as well. All right, so that's the good situation. Yes, there's a couple of hoops to jump through, but they still could take that. Again, I think largely we see this more on a 61 and above basis. I will also say, if I back up here, this age-based table changes every year. The IRS releases it, and actually it should be coming out any day now. So this table will change, and it does change each year, usually increases due to cost of living adjustments. So that new table will be coming out soon, but when your clients are filing taxes, they're, by April 15th, they're filing for 2022. So this still is very applicable. Okay, so now let's move on to business owners. So the good situation is those individual tax owners. The better situation, so good, better, best, the better situation are business owners. And business owners are classified in a number of different ways. So I'll start here with sole proprietors. So any of these pass-through entities, so sole proprietor would be a pass-through entity. They are the owner and employee, and they can deduct up to the age-based eligible premiums. So that same age-based cap table that I showed you, all those 10-year age bands, here's what they can do. So they file as a self-employed health insurance deduction on line 17 of their 1040, Schedule 1. They do not have to show any of that over and above a 7.5% adjusted gross income. So we get rid of one of the hoops here on the business owner portion. They do have to write these through the business, but now can get rid of that 7.5% adjusted gross income amount and just go straight to the age-based tables. Employees are deducted as a general business expense. So if the employer wants to write it on themselves and their employees, obviously it's a general business expense to the employer. Spouses and dependents can also be on there, and premiums not taxable to the employee. So yes, the business would take it as a deduction, but those premiums are not taxable to the employee. Now, I want to stop there because I want to consider this really quickly. If a sole proprietor's spouse is a bona fide employee, 100% of the actual LTC premium is deductible. Why do I say that? Why do I stop here? We have the ability to create a joint policy, meaning we're going to put both spouses on that policy and create a pool from them to draw from. There is an LTC portion of those premiums with what we have here for planning for long-term care expenditures. And if they're both going to be on there, the sole proprietor can put the spouse then as the owner of the policy, and they are just the spouse of that. So because they're a bona fide employee, it's in the spouse's name. Now we can show a way that the LTC premium would be deductible fully up to that age-based cap. So wanted to just quickly point that out, some things to kind of think of. All right, so other types of business owner situations, partnerships. So let's dive into that just a little bit. Again, we're back to just the eligible premium on the age-based tables. No 7.5% adjusted gross income, so we can wipe that out. Again, employees are deducted as a general business expense, so the total premium's there. Spouses and dependents are still here. Again, it's not taxable. Premiums are not taxable to the employee. And one other nice piece about this, LTC is not subject to anti-discrimination rules. So ERISA laws do not apply here. So partners can discriminate by class. What does that mean? Well, here's what I would recommend. Again, been doing long-term care for over 20 years now. First and foremost, those businesses must form a corporate resolution. They must take minutes on any of those, benefit discussions that they're having. And then also they can now class out what type of individuals would be eligible for a long-term care plan. So again, they don't have to cover all the rank and file. They can discriminate by class, but make sure that they make those, descript enough so that it doesn't look like it's just for the business owner, if you will. But again, I think that that's a key distinction here. It's not subject to any anti-discrimination rules, and they can discriminate by class. So partnership, much the same as sole proprietors. Here's your pass-through entities. So you're less than 2% holders, or greater than 2% shareholders in S corporations. So all of those sole proprietors, partnerships, and sub-S type of taxpayers and business are all pass-through entities. So let's go into this one just a little bit again as well. Again, can deduct to the age-based eligible premium, so that age-based table that I keep talking about, without regard to that 7.5% adjusted gross income. So again, we're still in that better situation. We get rid of that whole 7.5% adjusted gross income. Again, employees deducted as a general business expense. Or the same thing on spouses and dependents. Premiums not taxable to the employee, can still discriminate. If I move forward here a little bit further, the S corporation pays the entire LTC premium and deducts it as a business expense, similar to their health insurance. The entire premium is reported on the W-2 and their Form 1120S. The shareholder employee attaches the W-2 and 1040, but only deducts the eligible premium, age-based cap. Balance of the premium would be taxable. So again, still in that better situation. We're just going to that age-based cap table, wherever they fall in that 10-year age bands. That's the portion of the LTC premium that they could deduct. Those are the pass-through entities. Now, the best situation. So individuals is a good situation. All those pass-through entities are a better situation. The best situation is if you've got clients that are C Corps. This is the best situation out there. Why? Again, they write it through the business. Corporation deducts 100% of the total LTC premium available for themselves and employees, because as a C corporation, that owner is an employee as well. Spouses and dependents still are covered here. We're not subject to that age-based cap portion, so they get to deduct the whole portion of the LTC premium available. Shareholder is an employee, and again, we can still do that discrimination piece. So that's your best situation. C Corps, if you've got C Corp clients out there, there's no reason not to go and talk to them about any long-term care planning. And I will back up and say, look, aren't all of us on this call today, aren't we all business owners in some form or fashion? Yes, we are. So even if you're not a C corporation, you might be a pass-through entity. And you can get rid of that 7.5% adjusted gross income, write these types of LTC plans through the business, take it as a business expense, and only be subject to that age-based cap. As a matter of fact, I've got a great little timeline, if you will, of how this works. Again, least favorable to most favorable. I call it the good, better, best. But the good situation, least favorable, is the individual. So they've got to, meet that 7.5% medical threshold, and they're subject to those age-based caps. Us business owners, especially those that are pass-through entities, if we don't file as a C Corp, we're just subject to the age-based cap. We find where we fall on that age-based table and can deduct that portion of the premiums if written through the business. Take it as a business expense. The most favorable or the best situation is those C Corp clients out there, because we get rid of all of the hoops to jump through, and we can take the full LTC premium as a business deduction. So with that, I know that was a lot I threw at you in a fairly short period of time here. I will open it up for any questions. Tony, I don't know if you want to, if we're going to open the lines, or if you just are taking those in the Q&A section.
Taking them in the Q&A section. Can you hear me okay?
I sure can.
Okay. So looks like there's one. Someone's asking a question about an LLC.
Yes, that would be a pass-through entity. So that's that better situation that I keep talking about.
Uh-huh.
So LLCs, LLPs, gosh, I think there's another distinction out there, but since you specifically asked for LLCs, yes, they would be in that pass-through entity, those better situations, write it through the business, only subject to those age-based cap tables.
Okay. And I got another question. What does the rate reduction become, or excuse me, when does the rate reduction become effective?
Great question. Thank you for asking. So those will be available to quote and available for any new sales out there on 12/9. So next Monday, this Friday, not next Monday. This Friday, it all goes live on our quoting software and live for those premium reductions. I will quickly mention that since we asked about that question. Really what it impacts is our single pays and recurring pays on the 5-pay and 10-pay basis. Also that annuity funded whole life, which is really a 10-pay basis. That's kind of that qualified money structure. So that's where it does not impact our 20-pay or annual pay basis. So no changes there, but that reduction is on most plan options, just not the 20-pay and the annual pay going forward. And then that annuity funded whole life bonus increases from a 20% bonus now to a 25% bonus, all going live on 12/9 this coming Friday.
Okay. I am going to switch me back to presenter because there's a couple of polling questions that I want to get out to the group. All right, you see my screen?
Let me get out of mine and I can tell you. I am seeing your screen, yes.
Okay. Forgot to mention we also have the Seaside Sanctuary and double trip credits are effective from 10/1 this year to 11/30 this year. So yeah, we are in 2022. So I think that slide should have been probably taken out of there. All right, so got a few polling questions, a couple of polling questions. So the first one, if you'd like more information on the topic that we discussed today, I do have that polling question out there. If you could respond to that and make sure to get additional information out to you.
Yeah, and I've provided Tony with some really good follow-up pieces on this LTC tax deductibility. A couple great pieces. I've got a full kind of white page put together on that, and then there's just a single one-pager that's really easy to reference kind of how the deductibility works as well. So if you'd like that, please let them know.
All right. Okay, we'll close that one down. Next one, if anyone on the call has a client that you see an immediate need with what we discussed today, do have a polling question for you for that. And definitely, if you do,
Tax
make
time
sure
coming up. There's,
yep.
I think just about everybody would.
So for those of you that do, we'll definitely reach out to you right away on that. I'm going to leave this up here for a few more seconds. And then a couple more people still responded. All right. And lastly, if you're not appointed with One America and you're looking to get appointed, please respond to this polling question. We'll make sure to get the necessary contracting paperwork out to you. Quite a few people are still responding, looking to get appointed. So, Brent, that's always a good thing.
That is. Thank you all.
All right, so I'll close that one down. Now, as it usually happens after a webinar, you may have always have someone that has a question and forgot to ask the question. For whatever case, if you do have any questions, you can reach out to any of us here in the Life Department. As you see, my email is up here, as well as Greg, Trina's, and Beth. For today, it's just Beth and I. Greg is still on paternity leave, just had a new baby boy, and I believe Trina is out sick, but we do have people here in the Life Department to be able to answer any of your questions. And for this content and other content that we offer, please don't forget to follow and like us on Facebook and LinkedIn. With that, Brent, any closing thoughts, closing words?
You know, the last thing that I will say, again, Tony, I appreciate you having me on today to talk through this very valuable information. And I want to thank everybody for coming out to give me your time and attention as well.
And thank you for taking the time to spend this time with us today. And for those of you that were looking for additional information, looking to get appointed, we will definitely reach out to you today on that. With that, I want to thank everybody for attending today. Hope you have a great week, and we'll talk to you soon. Thanks, everyone.